you got to do the right thing, right? There are shortcuts and there are short-term ways to get things done, but that's never the right answer in the end, right? You have to have a long-term view. You have to be honest about when things aren't working the way that you thought they would and put that out on the table for everyone to look at and correct.
Prominent CEOs, leading economists, iconic investors. Insights from the experts. The Walker Webcast with Willy Walker. See who's next.
Hi, how you doing?
I'm good. How are you?
Nice to have you here.
Thank you for having me.
Thank you for joining me. Good morning, everyone. It's a real pleasure to be able to sit with my friend Michelle and talk about what's going on in the world of banking generally, and more specifically, commercial real estate, and JPMorgan's role in being the largest U.S. lender to commercial real estate. You've moved up at JPMorgan incredibly fast, and if we wind the clock back a little bit to when you were at LaSalle, and then from LaSalle into Bank of America, those are big organizations.
Yeah.
And you were singled out, identified as someone who had real talent. As you think back on that, of how you got those promotions and how you've moved up so rapidly in these big organizations, it's one thing for someone to be an entrepreneur, sort of like me, and go out and kind of do your own thing and build your own company and what have you. But to be in these mega organizations and actually stand out, I'm always amazed at people, for instance, who are in the military, who somehow rise to the top as the leaders in the military. How did Michelle Herrick get identified inside of LaSalle and B of A to be the leader you are today?
It's a good question. First of all, thank you for having me. I feel like I also need to thank you on behalf of our family dog, Murphy, because he gets longer walks when I'm listening to something interesting, which is almost always your podcast right now on the weekend. So it's really fun to be here. And yeah, let me tell you a little bit about my background and what I think myself, but a lot of people that I work with do that does differentiate. I started in a training program, LaSalle Bank, which was a large, maybe super regional, right out of school. I wasn't sure exactly what I wanted to do. And what that experience gave me, first of all, was 2005. So a very booming time in the CRE industry. And at a regional, it's kind of all hands on deck, right? Smaller team. So you're doing the large corporate lending. You're probably a tier 2 piece of the cap stack, but you're learning the covenant package, the asset allocations of the corporate users of credit. And then you're also doing a lot of the private side as asset managers were starting to go in that time, and then also specific project debt. If you forward a couple of years into my career, large acquisition of that regional for a variety of reasons, which gives me two things pretty early on in my career. The perspective of a regional versus a money center bank, and a major workout in the GFC, but in the portfolio that I was working, which included, regional credit, Merrill Lynch, money center, and a pretty tough time at the intersection of CRE and banking. And then I think specifically, so a lot of opportunity that I was there for early on, and then a lot of it is just knowing what guides you, right? Whenever I say I'm going to do something, I'm taking it seriously. I'm working really hard at it. And I think that whatever you're saying is important should be accompanied by action. I think that naturally lends itself, now that I'm in leadership roles, to more of a player-coach mentality. Or if I really believe in something, then I'm generally right there with people trying to get it done. I like clear roles and responsibilities because I think then we know who's doing what, so we can accomplish a lot together. And not to overcomplicate this, but you got to do the right thing, right? There are shortcuts and there are short-term ways to get things done. But that's never the right answer in the end, right? You have to have a long-term view. You have to be honest about when things aren't working the way that you thought they would and put that out on the table for everyone to look at and correct. And I don't think any of those are particularly special or unique to me. But I would assume that I'm on a path or have been put on this because I am able to bring those pieces together. It feels really good to be a part of an organization that values those type of characteristics. It also feels really great to be in the seat to make sure that my team and everything that they're trying to accomplish for all of our fantastic clients are under those same guiding principles.
So you mentioned clear accountability and responsibility.
Yeah.
You're in an organization that has over 300,000 people.
It's quite large.
It's quite large. We're a company of 1,400, and we have channel conflict conversations all the time. Yeah. This group has a client here, this group has a client there. We're clashing with each other. We've got who covers it and who gets the fees and all that kind of stuff.
Right.
I literally yesterday morning spoke to 2 different people in 2 different groups from JPMorgan before 9 a.m.
Yeah.
We're one of you are our largest partner as it relates to, we use JPMorgan for everything. So I'm talking to someone in the investment bank one day, someone in the commercial bank one day, talking to you the next day, talking to someone in the private wealth management group, someone on your trading desk, et cetera, et cetera. How do you create clear accountability in an organization that's that big?
Well, I think you touched on, first of all, thank you for your business. Really appreciate that you're talking to all of those people at our organization yesterday. And I think you're right. It's over 300,000 people. It's a $4 trillion bank. What comes with that is a really deep product offering. And what comes with the management style of the firm that I work at, which I love, it's how I ended up there, was a very risk discipline, consistency of capital for the economy view. And so then when you get into like, this is our guiding principle, right? We have our clients, we have our team. What we do in product offerings and how we get it done is going to drive impact to our shareholders and to our communities. And so you got to always circle back to there, right? There's a lot of people and they're all doing great things. But if everyone's trying to accomplish a shared goal, it would be somewhat crazy to have that then devolve into a fight for who gets credit for something, right? We're all a part of a team. We're all driving to a larger amount of success as a team. It doesn't work if you go for the individual victory.
Yeah, but that sounds great.
Yeah.
And I know it's true, but break it down to this, because there are a lot of people in this room who work in larger firms. They're in a law firm and they're working with a certain client, and then you bring in some other skill set and they're adding value, and it's hard to determine who really controls the client or who's actually adding value. If you think about us with you all,
yeah,
we've got over $1 billion of warehouse capacity from JPMorgan, which allows us to fund loans. We do hundreds of millions of dollars a year of financing with your balance sheet. We do hundreds of millions of dollars with your conduit. We have relationships on the investment banking side. There are all these fees that come from Walker & Dunlop that come back to JPMorgan. Where's the end of the year meeting that says, oh, it was Michelle hanging out with Willy in Florida at this conference that got us that big deal that ended up creating a huge fee, and who gets credit for it?
First of all, let's do that. Let's have that fee. Well, I think that's part of the culture, right? And what you're setting the expectation is from a leadership seat on how people are going to be viewed. That isn't a conversation that's going to happen. The conversation is going to be, wow, look at all that we accomplished this year with Walker and Dunlop. Who was involved? Let's make sure everyone gets credit.
Start a legacy. Start turning dreams into realities. A better world begins with you. Better communities start with us.
I was thinking about this. I've spent plenty of time with Jamie.
Yeah.
I have massive respect for Jamie. My question was going to be, I'm not going to pose it this way. I was going to say, what's the good, the bad, and the ugly of working for someone as iconic and great as Jamie?
Yeah, we're only going to talk about
I won't put you on the spot on that one. But talk for a moment about what it's like to have a CEO who is got the both experience, track record, and quite honestly, the clarity that someone like Jamie has.
I think it's a phenomenal experience, right? And our entire company and our clients and the economy benefit from it. But I think you hit it right. He has the experience. He has the clarity. When he is saying something, he means it. It's accompanied by action, which just at the most basic level, especially when you have hundreds of thousands of employees, is eliminating what can be the downfall of so many corporations, which is you're saying stuff, you don't really mean it. It becomes bureaucratic. It becomes unclear who's measured how, which tends to lead itself to infighting. And so I think having a really strong leader of a company that cares so deeply about it sets the groundwork for just a culture that flows through to the newest employees that join our firm or the most junior staff in, hey, this is a level playing field. We're all here trying to accomplish very clear goals, and we're going to get them done together, and then we're going to celebrate together. I really think, to the joke about the good, the bad, the ugly, I've not seen any of the second category. I find Jamie and his full leadership team, because everyone working there at that level is in the same discipline that he is, to be incredibly generous with their time, incredibly willing to share the good, the bad, and the ugly of management decisions they've made over the past several decades. And again, it sets up just a wonderful culture that I'm proud to be a part of.
Was it challenging when Jamie got out there and said back to the office ahead of all your competitor firms? I'm assuming that there were people on your team who came back and said, wow, whomever isn't requiring me to be back in the office, I might want to use this flexibility of work schedule and things like that.
I think, again, the context is important here because we're a large bank. So all through COVID, the majority of our workforce were working in the branches, in the lockbox centers. Everyone processing the money never went home, right? And as soon as possible, the trading desks were back. And then as quickly as possible, which generally was capacity for needing to space people out, most of the front office came back too, right? We're working with highly sensitive information. It's a very disruptive time in the financial markets, and we want to do a really nice job. And so I think, no, it wasn't hard. It was very much on message with the culture of our firm. And if I think about the specifics in my group, we were covering the real estate industry. So we were back as soon as we safely could be back because our clients had been there the whole time. And no one was going to see them except for us. It was great.
So what's that make you think about office right now? Just segueing, going from 30,000 feet of a big policy at JPMorgan and diving right into one specific asset class. But it's obviously, it's important for everybody in the room as it relates to what's the outlook as it relates to office and back to office and your portfolio of exposure to office loans.
Yeah. In summary, office is not dead, right? Look, space goes obsolete over time, and maybe low interest rates or the capital associated with maintaining buildings masked some of that and led to challenges in equity investments and loan portfolios. But the core of office, as a center of cities, as a place for people to gather and accomplish things, I don't think that changes in any way. I think what has changed in the last 10 years, really, but it was definitely evident post-COVID, is that large corporations are looking for spaces that have air and light and amenities for their employees, and they're willing to pay for it. And there is still very much a need for the BC class space, which has reasonable amenities and a lower chunk price, but we had too much of it. And particularly, you have a lot of it in these million-plus square footers that used to have a large corporate tenant, and now you have to fill 1 million square feet with 5,000 or 10,000 square foot leases each, right? That's really tough. And then exacerbating that, if you think about the supply demand and a little bit of the mismatch going on in office, when someone rents a new apartment, you don't agree to rip out the kitchen and replace it. But some of the packages and the capital associated with the leasing packages in the office, it can be tough economically for what makes sense and how to make investments and carry the assets. I sit in the Chicago Loop, one of the hardest hit areas. I spend a lot of my time in New York, Midtown New York, where you could watch this evolve over the last few years. And probably our most expanding market, particularly with FRB in the last couple of years, is San Francisco. So I'm in these three markets quite often, and I would say that the green shoots are there outside of New York. New York has been recovering, or whatever you want to call it, active with foot traffic, significant new leasing in the best buildings going on. And this is going to be a long duration problem as we work through the oversupply across the country, but office is not dead.
As we're on office, just two quick questions on JPMorgan and office. One, will you put debt on your new headquarters, or will it be all cash?
It's a good question. I don't know. I think it's cash.
Yeah, I think it's cash today in the construction. I'm just thinking about from a permanent standpoint, whether they'd turn to you and say, go go outside.
me.
And
Oh, no,
They
no.
won't. You won't put your own debt on it.
No,
I'm
we
thinking
can't
about
lend
putting
against
somebody else's
ourselves.
debt on it.
Yeah.
But by the way, if you need someone to finance your headquarters for you, we'd love to do it for you.
All right, we'll have David call you.
But the other one is, I understand that enormous building that is so cool to watch be built, and the way that you had to take down the old tower and ship everything out by that underground rail system and get it out of the city and then build this incredible headquarters. My understanding is that you now have space issues and that you're going to need to keep a lot of the space that you've moved into on a temporary basis in New York to be able to house all the JPMorgan employees.
It is quite phenomenal. So if you think about 2020, you take down a little over 1 million square feet, you're going to put up 2.5. And the assumption there is that you'll consolidate various buildings that we're in New York into one center where everyone's working together. Fast forward 5 years later, we will likely need 383 Madison, which is another 1 million square feet on top of the 2.5. We're in 390. We have 250 Park. We have ended up having the employees and the strength of the company and the desire to all be together to now have a little bit of a little campus in Midtown for JPMorgan.
It's amazing.
It's fun.
Yeah. Talk for a moment, Michelle. I said at the top, you manage a portfolio of $165 billion of outstandings. What's the best part and the most challenging part of managing a portfolio like that, particularly right now? It hasn't been exactly the easiest 2.5 years since the great tightening started as it relates to that portfolio's performance and what you've had to deal with. What's the best part and the worst part?
I think you're right. I took over running the large space 2 months before quantitative tightening began, right? So it was looking like we would have a decent run as an industry and then quickly became a little bit more portfolio management. But I think whatever environment you're in, and this is a cyclical industry, right? So the point is to do well throughout the cycle. It's the same good parts of what you're doing. Our clients are fantastic. They want consistency of capital. They want depth of product to have their businesses run better. The team is phenomenal. They are working so hard for all of those clients, many of which who have been with us for decades. And to delight a client, it's a function of, internal process and investments around, what is our process? What is our technology solution? Otherwise, it's manual effort by individuals, right? So you're doing this loop from my seat of how do we make this easier for fantastic people to deliver for these amazing clients? And then the output of how you figure those two out is what you're delivering again in a bottom line to shareholders who deserve a consistent return across a cyclical industry and communities. A lot of this is real asset development. So thinking about housing needs and how we're helping, particularly in the affordable across the country, and what we're contributing in real buildings that will exist for a very long period of time to our local communities. I think the best part is when you get it all right, and you're working with people that have shared goals around each of those pieces that come together for this amazing holistic story. I think the worst part recently is honestly Zoom.
Zoom.
Not
I thought you were going
Zoom.
to talk about, I had to sit down with this borrower and call their
No.
$150 million loan and they don't have $2 to put together to pay me back.
No,
We
don't do that. Listen, we're always
We don't do that.
collaborating
Hold on a
with our
second.
clients.
Hold on a second. You've got, look, you guys took your loan loss reserve in Q3 of 2023, so a year and a half ago, was $3.1 billion. And I know that covered more than just commercial real estate.
Right.
But this hasn't exactly been all roses over the last 2.5 years during the great tightening.
No.
And so you are dealing with some very significant credit issues and making sure that JPMorgan is protected against those credit issues. So
That's
you've
right.
clearly been pulled in to have really tough conversations with borrowers.
That's right. Yeah. Leading those conversations, of course. But I think, look, this is cyclical and we've all been doing this for a very long time. And so the key to those conversations is being honest about wherever you're at from the borrower side, from our portfolio allocation across different loan products or asset classes, because that's going to tell you what options you have to get through whatever challenge you're facing. And then working together. or not, but starting from the assumption that we're going to work together. And I think that's where banks should be at their best when there's an unanticipated issue or challenge to the economy, which COVID certainly was. No one would have ever, if I had taken over running the large space and said, I think every major city will close their downtown for some period of time next year. We should be, right. There are unexpected things that happen and you work through them together. And so those conversations always start from that core assumption to begin. And then you can kind of go from there with what the other side is sharing and willing to do for the variety of options and flexibility that you're going to offer someone. Yeah, we had realistic conversations. We were very aware of the challenges we had early on. And then again, it was a team effort to work through them. We were lucky to have quite a bit fewer than other banks, which let us spend the capital in new investment instead of losses from a CRE group. But I think any overconfidence in how you're doing things tends to, not work out for you the next time around. So we're happy with what we did. We continue to have some tough conversations in various areas, but overall as a portfolio, really excited about where we are, really excited about the investments that we're making for the ability to support those clients. And of course, always reminding real estate clients, this is a cyclical industry. So the way to avoid those tough conversations is you are setting a leverage level to allow for you to exist in a cyclical industry. And you always need a pocket of liquidity to get through. If you don't subscribe to that, you may be better off somewhere else. We're not trying to do a quick flip. We're trying to help you be incredibly successful over the long term.
So a couple things on that. One, if you look at JPMorgan's outstandings to commercial real estate versus your big SIFI competitors, B of A is below you at less than 10% of total loans outstanding is in commercial real estate. Wells Fargo is almost 2x you all at about 22, 24% of total loans outstanding to commercial real estate. You all are at about 12%. Are you actively advocating that balance of loans outstanding ought to grow to commercial real estate, stay about the same, or shrink down?
I think about it as a commercial real estate book at JPMorgan. We have a little over 200. We have a $4 trillion bank. So we're comfortably in the single-digit percentage on that equation, which I think is exactly where we want to be, because it gives us the flexibility to support our clients. There's no hard and fast number that we're managing to. We're here to support our clients in what they're trying to accomplish and make sure that works for our shareholders in a consistent return, right?
So there isn't, so right now, for instance, given what's happened in the last 2.5 years and the provisions that have been taken, you're not sitting there advocating, okay, now's the time to go long, let's grow outstandings in commercial real estate versus any other line of business?
No, I always am partial to commercial real estate. That's right. My role. I think as I sit in my seat with my team, we're really hopeful that the transaction volume materializes this year. We're really encouraged that even though rates are up, year over year from January, so are our pipelines in a significant way. It feels like, the capital is out there, the markets are functioning, there's a desire or timing pressure or capitulation that rates aren't going back to mid-threes to get going. And so we're very happy to be in a position where we can support everyone with that. There's not a deeper conversation around but we can only do a little. We have this number.
There's about, it's close to $1 trillion of commercial real estate debt that terms in 2025.
Yeah.
It's $900x billion. About $300 billion of that was loans that matured in 24 and got kicked to 25. Mm-hmm. And about $300 billion of that was loans that matured in 23 and got kicked to 24. When you look at 25 and your outstandings and what is maturing in 25, what percentage of those loans that are maturing this year do you think are going to pay off versus what percentage of them do you think you're going to kick down to 26, 27? If someone's got a SOFR plus 250 loan that's performing, Do you actually want it to, do you want it to go off your books, or do you want to just extend it for another year if they come back to you and say, could I extend it for another year?
It's a good question, but I think a lot of that was actually switching from short-term bank to short-term private, right? Because the bank, the advice would have been in 23 or 24, SOFR's higher than, right? You can lower your base rate by taking this out and fixing your debt. I don't know why you're still
Except typically
floating.
it's a cash-in refi.
That's right. And so we have some people that, were staying short, but the majority took the lengthen for, put it away for 5 years, put a hedge on it that lets you break in 3 or 4 if rates do come down a significant way, but don't stay in this constant angst of, is it going to drop in the next 3 to 6 months where I can get a better 50 basis points on my rate?
But on that, like all the lending we did in 2024, all of it was essentially 5-year fixed rate lending. And I sit there and look at that, and we do a huge volume, as do you all, and we did a ton of it with you. I sit there and say, what are these people thinking as it relates to where rates are going if they're only doing a 5-year loan rather than a 10-year loan? What's your outlook as it relates to, if I'm sitting here as a borrower of JPMorgan, and I say to you, Michelle, I've got this asset and I need to go finance it today. What should I be doing from a structure standpoint? Should I float because of exactly what you just talked about? Should I fix for 5 years, or should I push it out for 10 years because I think rates are going to go up from here and this is as good as it's going to get? What's your advice to me?
Two-prong. What's the rest of your portfolio, right? Everybody, one's ever
Let's
been
say I've
right.
got a very diversified portfolio in the capital structure. I'm almost agnostic to the capital structure. I want you as the expert to tell me, what type of financing do I put on this asset?
I would say 5 to 10, depending on what it is and what your hold appetite is for the asset, right? You're trying to match your duration. But
I guess in saying 5 to 10, you think that there's a chance that rates are lower in 5 years than they are today?
I think, and I've been in banking for over 2 decades, and we stare at interest rates every single day. We've almost never been right. So you're managing, I don't know that we've ever been right, actually. If I say it right, I don't even know that I need to caveat. So you're managing to a range of outcomes always. I personally am a little bit more risk averse, and I don't like, I feel more comfortable on the advice of it's 5. It gives you more time. It gives you, whatever asset you're owning, I am assuming that you're adding value to that asset or improving it, managing it in a way that should drive your income over that 5-year period, 10-year period, or else why would you be owning it? And so take the interest rates off the table as a short-term variable.
Yeah, I think one of the other things, and to your point about understanding what the strategy is behind it, a lot of those assets are owned by funds, which kind of bringing it back to this group. So the growth of private credit has been incredible. We just collectively worked on an asset here in Coral Gables last year where you all did a $245 million loan on a mixed-use development down in Coral Gables called The Grove that W&D worked with you all on. And that was taking out an Apollo construction loan. Talk for a moment about the competitive threat that comes from the private equity firms and the private credit world, and whether it's, who's your friend and who's your foe, in the sense of we compete hard against each other and we also partner with each other. How hard is it to deal with the Blackstones and the Apollos of this world as they get so big on private credit, yet they're also big owners of assets?
I was going to say a competitive threat. It's much more nuanced than that, right? As you know, sometimes we're fierce competitors and we have a lot of different relationships where then we're partners, client, borrower, right? It's becoming, everyone's growing larger and everyone's working together in various ways. If you pull out to the broader market that you referenced with the trillion that's maturing this year, the $5 trillion commercial mortgage market, right? There have always been a variety of debt sources in there. Banks are the largest. We're close to 2 of the 5. But life companies, agencies, CMBS, private used to be quite a small sliver. And what has been playing is they're inching towards double-digit percentage of the pie. I think that will continue, and they're taking their growth away from some of the bank piece. And many of the funds, I'm sure some of you in this room, your capital is efficient, and I don't think that's a bad thing, right? If a bank holds an outsized reserve against a loan and someone can offer it and make a better bottom line return, like that will play. And a lot of our clients have started debt funds. A lot of the debt funds in the industry are important clients of our firm. And so I think it's a functioning market that all is working well together. Where we've seen the last couple of years, and where I'll caveat that, the banks, some of them were froze up or failed as we went into this quantitative tightening piece. There was a real need for additional capital to step in and support borrowers. We were doing what we could, and what you would expect us to do as JPMorgan. We were taking an outsized percentage of a lower transaction volume market to try and do more to support our clients, but they had real needs that they couldn't find solutions for within the banks. And so I think private capital was very helpful and had a very strong value proposition in that period of time, and I expect to continue in the future. The only caveat I would say is banks tend to be able to lean in and feel a necessity to lean in when things are really tough in the economy, because you have this commitment to your local communities. I hope that's the case with the private credit piece. If you zoom out past the real estate, this is now a very large market that we haven't really seen go through a significant recessionary event. So it's tough to know how it can act since it's investor money. I'm hopeful, but I think that's my only caveat to this being just kind of a very functioning, great ecosystem that JPMorgan is working with, financing some, supportive of all.
So you all stepped in and bought First Republic during the Great Tightening. That expanded your real estate portfolio quite significantly. Mm-hmm. How do you feel about the loans that you bought in the First Republic acquisition? Because they're now in your book.
They are. I feel very good about them. That's the summary. First Republic had an exceptional client service model, right? And exceptional. They were very deep, right? We had to,
Has JPMorgan learned something from First Republic as it relates to how to engage with their clients?
I thought we were pretty good at it in the first place.
Look, I'm a huge customer of yours and love everything I get, but First Republic was unique.
Yes.
In the sort of the high-end private client space, and as it relates to clients of ours who'd been borrowers of First Republic before, right. Everyone would be like, I loved First Republic. They were so good. They were so hands-on. So, just curious. Have you learned anything from that? Of
course, right? And if you think about my history, I started in a model like that. I believe in that model. There's always a challenge of, you still have to deliver a bottom line result. And so how do you find the right balance of being all things to a client, but having a consistent return and efficiency and necessity as you grow to these larger organizations? On a simple level, yes, we've learned from First Republic. There's a lot to be admired there. The cookies, if you come see us, there's, we serve cookies now because who doesn't like cookies, first of all, but also
do you buy the cookies or do you bake the cookies? Are you guys got your own ovens going?
I personally do not bake the cookies, which everyone appreciates.
I wasn't asking whether you were. I was just wondering whether JPMorgan actually cooked them or bought them.
I think we cook them. Yeah, we have a full service. I imagine they're making them. And then, some of it just doesn't work for a large money center bank. You can call us. We can't deliver cash to you on the sidewalk because that's what you would like, right? There's additional procedures that we follow to protect all of our clients when you're managing such a large place. And so some of the flexibility that, comes with that local, very, very local model, because I think we have an incredibly local investment in communities and branch network, but we do keep tight procedures and process around protecting everyone's money at all times. You have to with how large we are. Yeah.
Let's talk for a moment about data centers. It's sort of the asset class du jour, if you will.
Yeah.
Long conversation yesterday on Squawk Alley between David Faber and Jim Cramer as it relates to Microsoft coming out and saying that, they're not messaging to the market that they're lowering their investments in data centers, and then Apple comes out and says that they're putting $500 billion, $500 billion of increased investment in the US. You sort of, I think, have two markets. You've got the hyperscalers who have unlimited capital and can do whatever they want, and I'm assuming they're not coming to JPMorgan asking for financing on those big projects. And then you have everybody else who's out there trying to build the capacity that allows for the JPMorgans, Walker and Dunlops, and others to go and access that. Are you bullish on the financing of data centers for non-hyperscalers, or are you more in a wait and see because there might be too much capacity being built today?
I think at a broad brush, data centers, if the capital flew out of office and marked it with a big X to some extent, it rushed into data centers. Anytime there's that much movement, speaking from a debt provider seat, right? There's clearly some substantial equity upside. You got to be careful because there's a lot of money and all things are not the same. So I would say we're bullish on data centers. We believe that there is a need here. There is a question around capital efficiency and how much these investments on a longer term, right? DeepSeek kind of gave us a first shock of, okay, there's significant investments, but how long will these go for? How much? And so I would say on a financing of data centers, we're involved, we're very active. We also are, watching the structures around, I'm speaking from a construction of data centers, right? What is equity risk? What is debt risk? And who covers if the power doesn't come, if the tenant has outs around a timeline, right? These are very, very large projects, which at a basic level, it's
What's the large, speaking of these are very large projects, I was just curious.
Yeah.
What's the largest real estate loan you can write and hold before you have to turn around and go syndicate it?
Not capped.
Not capped.
Right. We would be very careful. It would have a lot of eyes at different levels. But no, there's not a hard and fast.
So I guess then another way of asking that, what's the largest request you've had as it relates to a single loan? Because data centers are billions of dollars.
Yeah.
So, I'm assuming that someone's come to you and said, would JP Morgan finance the construction of a $2 billion data center?
Yeah. Oh, yeah, of course.
And are you doing that?
Look, I think everything that we do has it doesn't have a hard and fast, but it has a discipline around it, right? There's a lot of questions that you get answered in there that we need to answer in there. And we generally would take a loan that's of a significant size and syndicate it in market.
Right.
Right. Now, there's nuance all over that, so I don't want to say a specific number and get held to it. But yes, in the data center space, the requests are frequently in the multi-billion.
And so if I come to you and say, I want to finance the Fontainebleau, which is, this place has probably got I don't know what it is, it's got an $800 million CMBS loan on it?
I think we did it. Yeah.
I think you did it.
Yeah.
Yeah. So as you stayed here last night, not saying anything about the quality of the Fontainebleau and where it stands today, but as you look at a hospitality today in a place like Miami, you redoing this loan on the Fontainebleau, or are you pulling back a little bit on hospitality?
Look, across the board on the asset classes, hospitality is stable, right? And then there's always the nuance of how much capital has gone in, what will need to go in over the life of a loan refresh, et cetera, et cetera. But I would say across all asset classes, our view is stable to optimistic, right? There's a real need for housing in this country, and multi is our largest asset class by far. Industrial is strong. We do as much as possible. A lot of the refi volume there, it's a smaller market overall, and generally is put away for 10 years upon development. And retail gives me comfort, right? It's the office story.
Even big box?
I mean, there's probably a little bit too much of it, but retail is doing well as an asset class. And then you have all of the single family rental, senior storage, right? All of these have nuances around them, but in all of them, there's no red flag sticking out to us. We're optimistic across, including lodging.
You talked about the need for banks to be there all the time.
Yeah.
And you also talked about multifamily being your largest asset class.
Mm-hmm.
Talk for a moment about Fannie and Freddie and whether you think Fannie and Freddie are going to get privatized, and if so, how that impacts JPMorgan.
I don't know the answer to if they're going to get privatized. The impact is very manageable to JPMorgan. The question is two things that actually I think you're much deeper on this subject than I am, so I want to pass it over for your opinion. But implicit, explicit is a big piece. And then the mission statements of both of these agencies around liquidity in the housing market, affordability of the housing market, it couldn't be more critical when you look at the millions of units that were short. And so how do you make sure to maintain that in a private structure? Over to you.
I have a Walker Webcast on this specific issue tomorrow, which will be a great debate because I have two guests coming on who are on the don't privatize, and I have myself and another guest, Jim Milstein from Guggenheim, on the privatized side of things. It will be, I think, very interesting to see how it develops throughout 2025. I think that if it gets teed up as not part of the tax bill, but as an offset to the cost of the extension of the Trump tax cuts, there's a real chance that it gets on the track and really runs. And they look at it as we can raise $200 to $300 billion in an IPO of Fannie and Freddie. Let's get them privatized. I think that if you miss the window of the tax bill and the extension of the Trump tax cuts, it becomes far too kind of all the big theoretical questions that you just asked as it relates to what's their role in the market, and is it an implicit or explicit guarantee, and should they be kept in their existing box of lending, or should they be allowed to expand out of that? All those different things come into play. So I think that the debate in 26 is very different from 25. I think if it gets on the track in 25 and the president says, do it, I think a lot of the issues as it relates to, it will be in the framework of raising as much capital as they possibly can, which then says you better have a really strong guarantee, not explicit, but a very strong implicit guarantee. You got to allow them to operate in the private sector to be able to attract private capital and then grow. And all that has big issues as it relates to what's that mean to the banking sector? What's the counter to that? As you think about the privatization issue, the role that Fannie and Freddie have played in the housing market and the role that someone like JPMorgan plays in both the housing market as well as the just general financing market. Bill Ackman sits there and says, basically, you can pull all the guarantee off and just have Fannie and Freddie operate as private enterprises with a standby line from the Treasury for 25 basis points. I don't think that works. I think their bonds trade off tremendously if they get spun in that way, and that has a massive impact on the overall housing market and the cost of borrowing. So I don't think they can do the Ackman plan. And at the same time, I also am not a proponent of them just staying in the federal government forever. So it's a tough one.
Yeah, it's tough.
You obviously have a lot to gain if Fannie and Freddie are pulled back to any degree. And at the same time, you're also a big partner of theirs.
I was going to say, we don't think of it that way. We partner very closely with both of them. And again, I think if you look at the need for housing across the country, particularly affordable housing, it takes everyone involved, right? Private, government, nonprofit, local. This is a real issue. And so there's no assessment on our side of, wow, it'd be good for us if that. No, absolutely not.
Yeah. As you think about everything that's happening in Washington right now, which feels like we get a memo a day of something changing. Yes. We all look to, quite honestly, people look to JPMorgan, this fortress balance sheet that Jamie has consistently talked about. As you try and be the sort of, if you will, the lighthouse that everyone can, as the storms come in and as the seas get really choppy as it relates to where are we going and what's happening, everyone sort of looks to JPMorgan as that, the lighthouse of how to get home. What do you have to keep in mind right now in these challenging times? You talked about commercial real estate being it's a cyclical asset class. We have good times, we have bad times. What do you think about as you lead JPMorgan's commercial real estate lending practice on a national basis as it relates to how to kind of be there for your clients in these times that it feels like every day there's something else that's changing?
I think that's it. You're going to be there for your clients every day, even though it feels like every day something's changing. And we do a wonderful job as an organization. I'm very proud to be a part of it, managing our balance sheet and the expectations of our shareholders, that is our purpose, and we can do this very well. In the way, a step down, the way that you do that is you're always prepared for a range of outcomes because you don't know what's going to happen. It certainly feels much more noticeable when the last few weeks are happening, where we have a war room. They're sending out information of what's happening in Washington. Sometimes it can be a couple of times a day, right? There are significant things going on that can feel a little bit like a whipsaw, but we're focused in on supporting our clients through it. That my piece of that is, of course, supporting our real estate industry clients through it. And I think it's a little tough, right? There's impact in the policies that will likely play out in interest rates. And then if you look particularly in multi, we would have expected to see some more starts happening now that we're through kind of the wave of supply. But I think it's tough to pull the trigger when it's a 6-hour trade war. It's a tariff potentially on this piece, right? You're watching and helping people think through all of that so that they're using all available information as they run and manage their business.
It's really interesting your comment on starts, just really quickly, and we're almost at the end, so I don't want to go too deep on this one, but I had dinner last week with the mayor of Denver, and I was showing him a chart as it relates to multifamily starts in the Denver MSA. And you go back to 2010 and you look at starts, and when starts got to about 7,000 annual starts, that would play into around that supply in another year or two, and then that played into 3 to 5% rent growth. And then all of a sudden starts moved up to 10 to 15,000. And lo and behold, that plays through to 10 to 15,000 deliveries on an annual basis. And lo and behold, that brings rents down to flat to 2%. Right. And then all of a sudden we get into now an undersupplied market of 3,500 starts a year right now for the last 3 years in Denver. And Denver is going to be dramatically undersupplied. And all you have to do is go back to look at where they were on 7,000 a year and what happened to rent growth. You just know the picture that's coming, which is that rents are about to spike. And unless they do something to get more shovels in the ground, to get more supply coming in, the existing market is just going to explode as it relates to buyers wanting to buy assets at much lower cap rates, because once you buy an existing asset, you're going to be able to push rents. It's like right out there. You can see it. And there are these cities that are putting policies in place that are restricting new development, new supply, which is just going to end up hurting their consumers. I know. And again, from our perspective, a lot of those cities, municipalities are also our clients, right? So we view our piece in this as helping with some of the education around, well, here's what we've seen work elsewhere. Here's where we've seen smart policy encourage additional development. Every again, in the context piece, which is maybe what I bring to the table in terms of leadership, is like, you can all be right in your view, but we got to figure out how to bring them all together and get more housing in your town. My final question to you, as a very successful female executive who has 3 kids, what's the Michelle Herrick hack as it relates to the balance between a very, very demanding professional career and being a great mom?
Oh, I hope I'm getting it right. I think my hack may be trying something new every 3 to 6 months, because this can be really hard. I'm playing a team sport. My husband is working, it's a balancing act at our house. We have 3 children who are lovely, and I hope we're doing everything right to raise them to be incredible adults that contribute a lot to their communities. But it's hard, right? To my Zoom comment earlier, there's not enough time. And so I really like to know what we're trying to accomplish, have a good plan for how we're going to do that, know how everyone's going to interact to do it as well as we can, but to not waste any time while we do it, right? Because it just feels terrible for me, and I'm sure for everyone in the room, when you leave your personal life, go to the office, and wonder what you accomplished at the end of the day. Right? It's not the right way to feel.
You could write Elon Musk a note today and tell him exactly what it is that you did today.
Listen, we we send these notes on Friday. I mean, but it's like, hey, this was interesting in this meeting. This deal went like this, and here's the one thing I see that's going to come up that could be a logjam, right? I don't think it's bad to recap what you were doing. It kind of affirms that you did something during the week. I'm not weighing in on the Elon emails. I'm just saying that is something that I tend to do, and my teams tend to do as well. Of, we worked really hard all week. Some of that'll probably continue in some fashion through the weekend, but here's a few things that came out of it.
You said that your time is very, very valuable, and I greatly appreciate you taking the time to come down here and be with us today to have this conversation. And to everyone who's here, thank you for being in here and listening to Michelle Herrick. Thank you, Michelle.
Thank you.